Hello there, I'm Amira David. This is Boom Bust, and these are the stories we are tracking for you today. South Africa keeps interest rates steady on the back of a GDP report that defied predictions for a recession. But is there still underlying weakness ahead? South Africa's trade minister will weigh in. Then we'll talk about the potential for a Twitter takeover. The tech company says it's ready to hear offers, so who's buying? We'll discuss straight ahead. Plus, the UN cautions against a third leg of the global financial crisis. All, of course, on the prospects of epic debt defaults. Ed Harrison breaks it all down in the big deal. That and more is lined up for you on today's show. Don't go anywhere. It all starts right now. Worries over a recession in South Africa are beginning to recede after the central bank moved to leave interest rates unchanged, citing lower inflation and more optimism for growth ahead. Now, earlier this month, second quarter growth came in at 3.3%, thereby mitigating concerns of a second quarter technical recession following a dismal first quarter in which the economy declined by 1.2%. For more insight on that, I spoke to South Africa's trade minister, Dr. Rob Davies, who was here in Washington, D.C. on Friday. I asked for his thoughts on the critique made by many that despite a strong second quarter, underlying factors are still weak. Take a look.
I think we've got many points of weakness. Many of them are as a result of the changes in the global economy and the fact that we are a small economy which is highly integrated into the global economy. But integrated in the wrong place. We're integrated as producers and exporters of primary commodities. The prices of mineral commodities have all fallen, and along with other mineral economies around the world, we've been taking pain. So we've got vulnerabilities and weaknesses, but I was also trying to point out that we've got some green shoots. And our green shoots are from the efforts that we've been making over the years to industrialize and diversify our economy.
Now, when it comes to the global economic slowing that he was referring to, we know that China is a big part of that equation, but China is one of South Africa's most robust trading partners. So how exactly is South Africa adapting to this new reality? Here's his take on that.
China has been a major customer for our mineral products and a major driver of the fact that we had until 2012 a mineral commodity super cycle. Now that has all changed, and it's changed in part because of the different trajectory of the Chinese economy right now. But there's also another aspect to China, and that is that I think it's about 3 or 4 years ago that China changed from being a net recipient of foreign direct investment to being a net supplier of foreign direct investment. And we've seen a number of investments in productive activities in South Africa from China. Most recently, there was the sob turning ceremony for the largest investment in the automotive sector, and that was Beijing Auto International Company. And I think they recognize that production of motor vehicles for the African continent on the African continent is very important, and that South Africa offers a good location.
We also spoke briefly about the upcoming BRICS summit, specifically what South Africa was most hoping to accomplish. Take a look.
There are a number of issues that we will be wanting to be discussing. When we were the chairs, we hosted a study which was accepted by BRICS of areas where we thought we could promote value-added trade among each other. I think we would like to see that work taken further forward. I know we'll be having discussions of things like e-commerce in Delhi, but in general terms, I think it is to try to find a developmental perspective on trade issues.
Now, the BRICS summit will bring together leaders from Brazil, Russia, India, China, and South Africa. Boom Bust will be in attendance, which is very exciting, so stay tuned for more in-depth coverage. A few weeks ago, ITT Tech, a for-profit institution, was shut down by the feds over a handful of concerns. And now the government is going after the agency that was supposed to monitor those types of programs. Boom Bust, Bianca Vicini has the details.
When an educational institution is known more for its commercials than its job placement rate, something is probably wrong. But ITT Tech was in operation for nearly 50 years before it was forced to close, and the government is pointing fingers at an alleged watchdog group. On Thursday, the Accrediting Council for Independent Colleges and Schools was notified that it too will be shut down. A letter from the Department of Education says these violations reveal fundamental problems with the agency's functions as an accreditor. ACICS's track record does not inspire confidence that it can address all of the problems effectively. In total, officials found 21 violations, all while the agency received $4.7 billion in taxpayer funds last year. The ACICS has been responsible for accrediting over 200 schools that enroll around 600,000 students nationwide. So now the financial aid for hundreds of thousands of students is at risk, though the agency does plan on appealing. In a statement, the agency's president said, "We are confident that if given the opportunity to do so, we will be able to demonstrate major reforms and ongoing progress towards compliance with the department's recognition criteria." The agency will have 30 days to fight the decision, though a reversal seems highly unlikely.
And Bianca, my question is, what really happens to these students? I mean, where do they go from here?
Well, if they win the appeal, which, like I just said, is very unlikely, they don't have anything to worry about. But of course, if they don't win the appeal, they'll have 18 months to find another accreditor. But that's just very troubling because most of the students that are in these programs rely very heavily on financial aid.
Sure.
And if they can't, then they can't continue the program, and then they won't be able to transfer their credits anywhere. So it would ultimately be a very big waste of money for them.
Not the kind of stress you want to deal with as a college student.
Certainly not.
All right, Bianca Ficini, thank you so much for bringing us that story. All right, we first brought you this story yesterday as breaking news. Yahoo announcing hackers had made off with the personal information of at least 500 million users. It could be the biggest data breach in history. It happened 2 years ago. We are just learning about it now, and Yahoo says it thinks it was a state-sponsored attack. RT's Simon Del Rosario is joining us now with more details. So first of all, do we know anything more about the source of this hack? And also, I've got to ask you, why 2 years later? Why has it taken so long for this to reveal itself?
Right. Well, in a statement, Yahoo twice said the phrase state-sponsored actor. They said it to say the information was stolen in 2014 by what they believe to be a state-sponsored actor. And they said they don't think the state-sponsored actor is still in the system, Amira. What they don't say is why they believe this is a state-sponsored actor to begin with. And any security analyst that is commenting on this case is bringing that point up. Yahoo said that online intrusions and thefts by state-sponsored actors have become increasingly common. We hear about it in the news all the time. Who are these most likely state-sponsored actors? Well, we know that China and Russia have huge capabilities, just like the U.S. But experts are questioning the motive here, saying that this type of hack, the information that is coming out of this Yahoo hack, it's not typical of a state actor hack. It doesn't give countries any gain. There's no sort of espionage advantage to this. However, it would be less embarrassing for Yahoo if it is a state-sponsored hack, because then we're talking about thousands of hackers working on gathering this information rather than, well, a few people in a basement that happen to hack one of the biggest companies, one of the biggest data breaches that we've seen in history. Yahoo says they were alerted to the hack after an earlier investigation into a hacker called Peace that claimed to have had about 200 million user information that they were planning on selling online. When they looked into it, they realized it was actually a much bigger problem.
Wow. You know, this comes, of course, as Verizon is trying to work out a deal with Yahoo. It's trying to purchase Yahoo for nearly $5 billion. And a lot of people are asking today, with that deal sort of still in the works, still going through the approval process, if you will, if this latest hack may have any bearing on it whatsoever.
Absolutely, it could. I mean, Verizon made the deal back in July, but it has not been finalized. There's very good reason to believe that this could change. And I think it has a lot to do with the way that Yahoo has handled this attack in the first place. Yahoo obviously found out about the potential hack a while back, earlier this summer, and they've been investigating it. But they didn't think that it was important to tell Verizon about this information, even though Verizon announced this deal back in July. And as you mentioned, is spending nearly $5 billion for the company. This is what Verizon said. They actually released a statement saying that within the last 2 days, we were notified of Yahoo's security incident. We understand that Yahoo is conducting an active investigation into this matter, but we otherwise have limited information and understanding of the impact. We will evaluate as the investigation continues through the lens of overall Verizon interests, including consumers, customers, shareholders, and related communities.
Wow.
Until then, we are not in a position to comment further. So basically, Verizon found out about it about the same time that
Everybody
we did.
else did.
And they're clearly pointing out in this statement, their shareholders are going to mean more to them in this business deal than Yahoo.
Yeah, it's clear Yahoo didn't really want to volunteer this information. By the way, there are some other reports about another tech company that is also going through a potential selling process, and that company is Twitter. I was a little surprised to hear this news, but what do we know about that?
Well, Twitter's been struggling lately, so the news isn't quite as surprising, and they were just rated to underperform again, but their shares soared today on the news that it's getting closer to being sold. There are several tech companies that are reportedly interested. You can see the soaring shares right there on that graph. Google is a company that's been rumored to be interested. Salesforce.com. The board of directors at Twitter, very interested and open for a sale. They are looking to make a deal. That doesn't mean they are close to a sale. That is not quite imminent yet. But Twitter, as I mentioned, it's been lackluster at best. A lot of people attribute that to the weak ad revenue. Companies that are interested in Twitter, they're interested in more than just its social media aspect, but also the data that it generates there.
Yeah.
So we get so much information from Twitter and really a pulse on the nation, what people are talking about, the nation and the world.
Yeah, I think I was just surprised because Jack Dorsey, the CEO, just came back in to sort of rejuvenate the company. Exactly, and try to boost the company's sales and profits and all that good stuff, but he has not been able to do so. So I guess this is the logical next step.
Right.
Simone Del Rosario, thank you so much.
Thank you.
All right, still ahead here on Boom Bust. U.S. stadiums have received over $3 billion in tax breaks over the last 15 years. That's a lot of cash that could be going to vital city services. So are those deals really worth it? That's straight ahead. Plus, the UN cautions against a third leg of the global financial crisis. Ed Harrison will tell us what it has to do with the prospect for epic debt defaults. That's on the other side. Stay with us. And as we go to break, here are the numbers at the closing bell.
Earlier today, President Obama
Senate Republicans previously stated that the component responsible for poisoning people in Flint.
There was always hope.
That's what goes
Trump
on
is
in
making a lot of
politics.
noise
What
about
are
mixing
women
race.
supposed to do? Here's something else we know.
Between the U.S.
Lawyers
and
at the
Cuba.
ACLU have already
Some degree of loss in
It's a
business.
huge difference.
following the announcement, oil
Why nobody's
prices.
talking about this story? Because it's garbage.
Real, genuine, and significant change.
Hillary Clinton, bad judgment. Let's defeat her.
A man you can bait with a tweet is not a man we can trust with nuclear weapons.
She is their puppet, and they pull the strings.
We will not ban a religion.
We don't want them in our country.
We will not build a wall.
A great border wall, believe me. USA, USA.
Municipal governments in the U.S. compete fiercely for business tax dollars, often by offering tax breaks. A good example of that is sports stadium deals. And when a new study by the Brookings Institution looked at 45 stadiums in the 4 major sport leagues that have been built or renovated since the year 2000, they found that the aggregate tax breaks came to $3.2 billion. That's a lot of cash that municipalities could be using to provide other vital city services. So are these deals really worth it? That's exactly the question that Ed put to our next guest, Victor Matheson, professor of economics at the College of the Holy Cross. Take a look at what he had to say.
So the vast majority of economists who've looked at these suggest that the economic benefits of building new stadiums is either vanishingly small or zero. The typical economist would say if a team wants to build a new stadium, they should build their own stadium. But it makes no sense for taxpayers to be subsidizing the businesses of billionaire owners and millionaire players. What was particularly interesting about that Brookings study, though, is that actually wasn't direct subsidies. Those were subsidies that were hidden. These are subsidies that teams got because they were able to issue municipal bonds, which are tax exempt. And therefore, it's not even the citizens, for example, of Santa Clara, California, paying for a team for a new stadium in Santa Clara. It's actually taxpayers all across the entire United States paying for stadiums all across the country. So, in fact, you have the citizens here in New England, Patriots fans, subsidizing the stadiums of folks like the New York Giants. That's almost certainly not what a typical taxpayer would expect.
Right. Hey, let me give you a specific example that came up recently when I was looking at this issue. Cobb County, Georgia, recently they did a deal with the Atlanta Braves that some people are saying was basically terrible. Fewer parking spaces, harder to reach via public transport, fewer stadium seats. It really seems like it doesn't make a whole lot of sense, frankly. And the politician responsible for the Braves Stadium lost re-election as voters exacted their revenge. Let me ask you, are we seeing a turning point in how people view these deals?
Well, it certainly seems like we had a big turning point in 2008. When the Great Recession hit, we also had a significant slowdown in the number of new deals that were being announced. So, for example, we were seeing actually 3 or 4 new stadiums in the big leagues here coming on each year. That slowed down to about a stadium a year after that, as taxpayers found it pretty disturbing to be giving huge subsidies to professional sports while they were laying off police officers and firefighters and school teachers. That being said, as the economy recovered, we have now seen some of these big deals coming back again. Some of them are better than others. We see a new stadium deal going in LA that's almost entirely privately financed. We saw a new deal for the San Francisco 49ers, which was 90% private money. But you see one of those, and then all of a sudden you see deals like the proposed new stadium in Las Vegas that Sheldon Adelson, a supposed friend of getting government out of people's pockets, now that it's his deal, wants the government back in taxpayers' pockets for $750 million. That would be the largest subsidy of a stadium in U.S. history in order to bring the Oakland Raiders to Las Vegas. It's also the height of hypocrisy.
Yeah, it does. From what you're saying, it really doesn't sound like a whole lot's changed. Maybe when we have a downturn, people will start to reevaluate slightly differently. But I want to cut over to Formula One because, Formula One was recently sold to John Malone's Liberty Media. My question is this a good deal for Liberty, and is it a good deal for the sport?
Well, so obviously you had an aging Ecclestone, right? He's, 85-ish. So at some point that franchise was going to turn over to someone. At $8.5 billion, that's a nice chunk of money. That makes it, I believe, the largest single deal ever in world history for a franchise or league, bigger than, for example, the Dodgers here being sold in the United States for $2.4 billion, or the Clippers going for $2 billion. That being said, it's a very odd, it's an odd sport in some ways, in that popular around the rest of the world, but has never, ever gotten any inroads into the largest media market in the world here in the United States. And so having an American company taking a big position in a sport that has never been popular in the United States is kind of interesting. That being said, professional sports like auto racing and, of course, football and all these others remain one of the very last places that people still watch live. And so that makes it very alluring to advertisers, because people don't, just fast forward through the advertisements, or they don't watch it on Netflix or on Amazon Prime where there's no commercials at all. And so, again, that makes the sports landscape pretty valuable to advertisers.
That makes a lot of sense. And, even though you gave me the thing about the Los Angeles Dodgers and the $2.4 billion, actually, I was kind of surprised at how low a price tag Formula One garnered. I think it was $8 billion for the whole thing. In your view, what should the sport do under Malone to increase value going forward? It sounds like it's going to be something in the United States.
Well, that really is the key, right? It's one of the great untapped markets, and it's hard to know exactly why it's not popular here. It's considered an upper class sport in many other places in the world. For example, the Monaco Grand Prix, attracts all of the wealthiest and most highly dressed. And so maybe Formula One has a slot here in the United States as maybe a counterpart to NASCAR, which is considered often to be the sport of the working class. And so maybe there is room for two auto racing circuits in the United States. But I think that remains to be seen. And Formula One's tried the United States on many occasions, and it just hasn't seemed to take hold.
Right. Last question for you here, Victor. What's your postmortem on the economic benefits of the most recent Olympic Games that were held in Rio de Janeiro, Brazil?
Well, I had the good fortune actually to go down for some of those, and the games itself went off fairly well. The security was tight. They had obviously the venues were finished in time. The problem is that you'll never be able to make enough money during the Olympics to actually cover your expenses. And so what you're hoping for is some sort of great advertising effect. Unfortunately, at least what most of the people here in the United States heard about Rio was not about what a great place this will be to go next year for just a family vacation. We heard about the crime, we heard about the pollution, we heard about the political unrest, we heard about the economic uncertainty. And unfortunately, that's just not the sort of thing that's going to make Rio all of a sudden pop to the top of everyone's tourism lists. So unfortunately, the long-term tourism legacy just doesn't look that great from Rio. And I think probably even worse than any sort of legacy they might have gotten from the World Cup 2 years ago. I think the coverage of the Olympics was significantly more negative than the coverage of the World Cup, and I would be significantly surprised if we had any sort of large tourism increase following this last Olympics.
It's big deal time. I'm sitting here with Ed Harrison. We were talking about emerging markets. Now, earlier today, I had the chance to talk to South Africa's trade minister. He's pretty upbeat about South Africa's economy on the back of unexpectedly strong GDP numbers for the second quarter. But when it comes to emerging markets in general, the UN has recently voiced concern that private debt is stirring up some trouble. They say there's been a, quote, explosion of corporate debt levels in emerging economies, which now exceeds $25 trillion. Damaging deflationary spirals cannot be ruled out. Ed, let's start right there. When we talk about this debt, what exactly is the UN keying in on? What are they most concerned about?
Here's the stat that I would look at is corporate debt. They're looking at corporate debt after 2008 going from 57 trillion to, or 57% of GDP, sorry, to 114% of GDP. So basically doubling as a percentage of GDP over an 8-year period. And obviously, irrespective of whether or not whatever was going on in the developed economies was happening, this was keeping aggregate demand, global growth going, and that's the first thing that they're really concerned about. But more than that, I think that when you look at the debt service costs associated with that, that they've soared. So debt service costs in the emerging markets have gone way up, while you see all of this deleveraging in the advanced economies. So that divergence can't last, and it's unsustainable.
Right. And just yesterday, the guy who coined the phrase currency war, he was arrested. This is Brazil's former finance minister, Guido Mantega. He was arrested on corruption charges. But you say that phrase that he coined, currency wars, that really gets at the heart of this emerging market problem, right?
Yeah, exactly. I mean, basically what happened is we had a developed market crisis, and as a result of that, these guys took all their monetary forces and took rates down to zero, started pumping in QE, et cetera, and all the hot money out of the developed markets flowed into the emerging markets. That pumped those markets up. Currency wars, as Mantega said, everyone talking about Jim Rickards. He has a book about the currency wars, and what do you know? You get a massive explosion in debt in the emerging markets. And unfortunately, that debt level explosion has been so high that it's now become unsustainable, and this is exactly why the UN is concerned.
Right, and we talked about Turkey yesterday. You told me that you felt their problems were really Turkey-specific, not necessarily something across emerging markets, but you did express some worry over the borrowing of the U.S. dollar by emerging market corporations. Tell me more about that.
Yeah, so I think that one of the things is that the U.S. dollar is the world's reserve currency, and as a result of that, when people borrow and they want liquidity in markets, they go to the U.S. dollar for borrowing. And when the world's reserve currency is in a different situation than everyone else, which is what we're seeing now with the Fed saying that they want to hike interest rates.
And the dollar going up.
And the dollar's gone up. If you look at the U.S. dollar index, it's actually near its high in the post-financial crisis period. And so what that means is that debtors in emerging markets are going to have problems paying back their debts in dollars, and that's going to create a crisis. So I think that we're looking at hot money, currency wars, U.S. dollar being high, and all those things coming together in a very negative way.
I mean, is there any scenario in which this does not end very, very badly?
No, I think that all of the scenarios that we're talking about, you will see it ending badly, and ultimately what we're going to end up seeing is defaults en masse in the emerging markets. Whether we have a crisis or not, that's another question altogether, but I think that the end game here that we're talking about is corporate defaults, because none of this is sustainable.
And what about developed economies? Are they any better off?
They are better off to a certain degree, but they do have their own problems. I think the problem that we have is a slowing in the economy and a sort of maldistribution of economic gains. Because if you look at the developed economies, what's happened is wage growth has been stagnant, but at the same time you see very high corporate profit margins. At the same time that you also see stagnant productivity. If you look at private investment and you compare that to the corporate profit margins, what you see is things going in opposite directions. And I think that the thing that connects those two is the stagnant wages. Why would you actually, if you're not getting enough wages to support the economy, go out and build new factories or add capacity, because no one's there to actually build up that capacity. So what we see instead is an increased padding of these profit margins, and stagnant wages will continue. I think it's a big problem that will come to a head.
Also could end very, very badly. Ed Harrison, let's leave it there. Thank you so much. Make sure you tweet at all of us. Edward NH, Bianca Fascini, Simone Reports, Amira David. Catch us on YouTube, youtube.com/BoomBustRT. From all of us here at Boom Bust, thanks for watching. Have a great weekend.